The exchange traded fund, or ETF, might possibly be the single biggest cheat code when it comes to investing. With just a single ETF, you get to invest in hundreds, if not thousands of companies, thereby diversifying your holdings. Not only that, the beauty of investing in an ETF is that everything is done for you automatically. Good companies grow larger, while bad companies just shrink smaller and eventually get replaced by better and stronger companies, effectively boosting your returns over the long run. This saves you a ton of time from doing all that tedious research. And the best part, you get to enjoy all this convenience at a very tiny fraction of the price, with some even going as low as 0.03% in fees. In this video, I'll be introducing some of the best ETFs you can invest in as a beginner, so that you can kickstart your investing journey in the right direction. But before I start, do join my 9,000 members Telegram chat group to discuss or ask any questions that you may have. First up on the list, we have the good old S&P 500 ETF, ticker symbol CSPX. This ETF tracks the largest and most profitable 500 companies in the US and possibly even the world, such as Microsoft, Nvidia, Apple, Amazon, and so on. And just in case you are wondering why I chose CSPX over many other popular S&P 500 ETFs such as VOO and SPY, it is because CSPX is an Ireland domiciled ETF. This means if you are not from a country that has a tax treaty with the US, rather than getting slapped with a 30% dividend withholding tax whenever you receive dividends, with CSPX, you are now only getting slapped with a much smaller 15% dividend withholding tax. Okay lah, it's still a slap, but a much gentler one, yeah. CSPX has an expense ratio of 0.07%, which means for every $1,000 invested into it, 70 cents goes to feeding the fund manager every year. Around 30% of its holdings are in the tech sector, followed by 12% in financials and another 12% in healthcare. This ETF is a dividend accumulating ETF, meaning instead of paying out dividends, it will just automatically reinvest its dividends back into itself, thereby saving you the effort and the fees of reinvesting the dividends yourself, while also activating the magic of compounding. CSPX has given some fantastic returns in both the short term and long term, with its 1-year annualized return coming in at 24%, 5-year at 15%, and 10-year at 13%. And if you stretch it out even further, its historical annualized return since the index inception from 1957 till now has been around 10%. This is despite going through all its crazy crashes and volatile swings. The S&P 500 has not only managed to come out on top, but also beat 94% of professional fund managers along the way. And what's even more amazing is the fact that historically, if you were to invest in the S&P 500 over a 20-year period, you will not encounter any losses. This is the reason why Warren Buffett firmly believes that the best thing for any investor to do is to own the S&P 500 index fund. Now, don't get me wrong, I'm not saying that the S&P 500 will continue to give such amazing returns into the future, but barring any black swan events such as World War III, alien invasion, or AI taking over the world, I would say that the S&P 500 would be a pretty good long-term bet. Quick pause, if you're looking for a broker that gives you free trades, low FX settlement rates, and has transparent pricing, you can check out CMC Invest. CMC Invest is currently giving all clients a complimentary 12-month free upgrade to the Invest tier, which gives you a total of 45 monthly free trades across Singapore, US, UK, Hong Kong, and Canada market, as well as 0.2% FX settlement rate, which is perfect to DCA into various stocks and ETFs. Besides that, you will also get up to $282 worth of Grab and Tesla stocks when you meet the minimum funding and trading requirements. What I like about CMC Invest is that you get to invest without having to worry about unexpected fees. All the fees are clearly stated before you place your trades. They are also a part of the CMC Markets Group and backed by 30 plus years of trading excellence in the APAC, UK, Europe, and Canada. So you know you are investing with a trusted broker. So do sign up to CMC Invest with my link down below and kickstart your investing journey today. And with that being said, let's get back to the video. Next up, we have the Vanguard Total Stock Market ETF, ticker symbol VTI. While the S&P 500 ETF focuses solely on large cap US companies, VTI focuses on the entire US stock market. This includes large, mid, and small cap companies. VTI expense ratio is incredibly cheap at just 0.03%, which means for every $1,000 you invest, 30 cents goes to the fund manager every year. This ETF has a whopping 3,700 over stocks, which means it's way more diversified than the S&P 500 500 ETF, though most of its top holdings are the same name that you have seen before, such as Microsoft, Apple, Nvidia, and Amazon, though at a slightly smaller weightage as compared to the S&P 500 ETF. Likewise, its sector allocation is also pretty similar to the S&P 500, where its top 3 sectors are in tech, financials, and healthcare. Despite its huge diversification, VTI's past 10-year performance is almost on par with the S&P 500 ETF, while underperforming by a slightly more than 10% return. However, what's more interesting is that if you scale it out to a longer time period, say 2001, VTI managed to beat the S&P 500 by around 30%. But why is this the case? That's because VTI also holds small and mid-cap companies, which has the potential to grow a lot faster as compared to well-established large-cap companies. The only reason as to why the S&P 500 managed to beat VTI over the past decade was because large-cap stocks during this period, especially with Magnificent 7 stocks, were doing most of the heavy lifting. And because of that, many analysts believe that over the long run, VTI would eventually outperform the S&P 500 once again due to its small and mid-cap holdings. Speaking of outperforming the S&P 500 ETF, you will love the next ETF, introducing the all-famous Invesco Nasdaq 100 ETF, ticker symbol QQQM. Why QQQM? Shouldn't it be QQQ? So the reason I went for QQQM instead of QQQ was because QQQM has a slightly lower expense ratio of 0.15% as compared to QQQ's 0.2% expense ratio. This means by investing in QQQM instead of QQQ, you will get to save on 50 cents in fee for every $1,000 invested every year. While this doesn't sound much, it can actually add up to quite a bit, especially if you are investing a large amount and over the long run. This ETF invests in the top 100 non-financial companies listed on the Nasdaq index. And if you were to look at its sector breakdown, this ETF is especially heavy in the tech sector, coming in at 51% weightage, which is then followed by 16% communication services, then 12% in consumer cyclical. As for its top holdings, you will see familiar names once again, but at a much higher weightage as compared to the S&P 500. Given its high weightage in the tech sector, it shouldn't come as a surprise that QQQM's returns have been rather fantastic. Over the past 1 year, this ETF gave a 31% annualized return, 3-year, 12%, and 19% over a 10-year period. However, with great power comes great responsibility. Oh, sorry, wrong quote. I mean, with great returns comes great risk. When times are good, the Nasdaq 100 would easily outperform the S&P 500. But when times are bad, such as during the 2008 Great Financial Crisis and the 2022 market crash, the Nasdaq 100 would fall a lot harder too. So if you are someone who wants the potential of higher return and doesn't mind the higher volatility, this is the ETF that you can go for. Next, we have the FTSE All World UCITS ETF, ticker symbol VWRA. While the S&P 500 focuses on top stocks in the US, VWRA focuses on the top large and mid-cap companies across the entire world. Its expense ratio comes in at 0.22%, which means for every $1,000 you invest, $2.20 goes to feeding the fund manager and the family. While this may seem a little high, especially when compared to all the previous ETFs that I've shown to you, the good thing about VWRA is that it's also an Ireland domicile ETF, which means more tax savings. First, you get to enjoy a lower 15% withholding tax on dividends paid out. And second, unlike US domicile ETFs, where you can be subjected up to 40% worth of estate tax on your investments when you pass away, oh sorry, it's no longer your investments, it's your descendants' investments now. Ireland does not impose an estate tax on your investment when you pass away. So your descendants will get to keep 100% of your investments, which is always nice. 61% of its holdings is in the US, whereas the rest are spread across other developing and emerging countries such as Japan, UK, China, France, and so on. As for the sectors, this ETF has 26% of its holdings in technology, 14% in financials, and 13% in consumer discretionary. Besides the many familiar names here, you also see some non-US companies such as Taiwan Semiconductor Manufacturing, Novo Nordisk, ASML Holding, and so on. VWRA has a 1-year annualized performance of 23%, and since this is a relatively new ETF, it doesn't have 5 years or more worth of performance, but we can still get an estimate based on its benchmark, which in this case would be 11% annualized return for 5 years and 8% for 10 years. But here's a question, why would you even want to diversify across the entire world? Didn't I just say the best companies in the world are in the US? This is because by just investing in the US, we will have market concentration risk. And if anything happens to the US, all our investments will jibaboom and fail. So by investing in VWRA, we will be diversifying our investments across the entire world, aka geopolitical diversification. Not only that, we will also be able to capture potential growth from other markets. Like for example, did you know that in the past, there were times when emerging markets actually outperformed developed markets? And it's only within the past 1 to 2 decades that the US started doing really well. This is also the reason why Vanguard believes that even though US stocks have been outperforming international stocks over the past 10 years, this trend may not continue in the next 10 years due to reasons such as valuation expansion, higher dividend yield, and the rise in foreign exchange. Last but not least, we have the Sharp US Dividend Equity ETF (SCHD), which holds the top 100 dividend-paying companies listed on the Dow Jones. This ETF has a total of 103 holdings, of which 17% of it is in financials, 15% healthcare, 13% consumer staples, and so on. And as expected, you won't see too many of the tech stocks here. Instead, they are all dividend-paying companies such as Texas Instruments, Amgen, Lockheed Martin, Coca-Cola, and so on. Its expense ratio comes in at a rather low 0.06%, which means for every $1,000 you invested, 60 cents goes to keeping the fund manager happy. However, the downside of this ETF is that since it's domiciled in the US, if you are from a country that doesn't have a tax treaty with the US, there will be a 30% withholding tax whenever you receive dividends. However, some investors are willing to look past this, given that this ETF has a fantastic track record for its performance, with a 1-year annualized return of 17%, 5-year at 13%, and 10-year at 11%. This includes both capital gain and dividend reinvested. And the fantastic thing about investing in good dividend ETFs like this is that its dividends will steadily grow over time, effectively giving you a pay raise as the years go by. The other benefit of investing in a dividend ETF is that it tends to be a lot less volatile as compared to ETFs like the S&P 500 or QQM, thereby making it suitable for investors who prefer stability. Like imagine if you own the S&P 500 and you need to sell off a small portion of it every year for income. Some years you get to sell for more money, other years you get to sell for less. That would be super unpredictable. But with SCHD, all you need to do is just collect the steady stream of dividend payouts, and whatever happens to the stock doesn't concern you, as you are not selling off the holdings for money. Alright, here is my take. If I only had to pick one ETF, I would go for the S&P 500 ETF, CSPS, due to its strong track record and amazing potential. But if I want to be a little more thorough and not just invest in the top companies in the US, but also invest in the small and mid-cap companies for their potential growth, I would go with the Vanguard Total Stock Market ETF, VTI. However, if I want to mostly invest in fast-growing companies and I'm okay with all the huge volatility, I would go for QQM. Otherwise, VWRA is another safe bet for long-term investors, given that I will be practically investing in the entire world. And lastly, I will go for SCHD if I like to have passive income and don't mind paying the 30% dividend withholding tax. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.